Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. As the smoke pours down from Canada,
it is very dramatic.
The Bank of Canada then raising rates, which is also dramatic. Let's get right to the biggest stories right now in the more than $9 trillion global ETF industry. It's an unexpected hike. With the U.S. debt deal done, investors are now focused back on central banks after the BOC delivers a surprise move.
And in the ETF world, after JPMorgan's success in active ETFs, Goldman preparing to launch funds that look quite similar to their rival bank.
And now that it's the start of summer, people are planning vacations, and we look at one ETF that's ready for a getaway.
Before we get there, though, Matt, as always, we have Eric Balchunas from Bloomberg Intelligence. He's here with us now looking at the flows. Eric, what do you got?
Katie, Matt, thank you. I've got more good news in the flows. Last week I gave you good news that equity ETFs had finally started to wake up a little bit in terms of flows. As you know, there's been what we call the FOMO drought all year. Equities up big, but no flows to back them up, right? So IWM taking in $2 billion, that's a good sign. VU, that's good. You want that Vanguard relentless bid to keep coming in. HYG, the Qs, that's a nice little risk-on pocket there of both buy and hold and the trading crowd, which I'll expand on in a minute. Let's look at the outflows. VGT is at the top. Remember last week I said that the inflows into VGT were likely a rebalancing and we shouldn't get excited? Some people got excited, but we were right. It's a rebalancing thing, so it doesn't count. That's $6 billion out. So again, ignore that. SPY's $1.2 billion. That is notable, but still $8 billion over the past month. So SPY's still in good shape there. EEM, that's again the emerging markets. But look at how small the numbers are. Again, they net into a big positive number. Now let's look at the different types of players in the market, because the buy and hold retail investors that like Vanguard and Schwab, this is the orange line here. They're buying their ETFs just like clockwork. You really can't shake them. The white line is the trading crowd. These are the people using SPY, the Qs, the real liquid ones. And you can see how volatile that is. They were completely missing the first part of the year. They come in here and they've been down a little bit. They come back for 3 weeks though. Even though that SPY outflow shows up here, I like this. I'm going to take this as a positive takeaway and to trend up that the trading crowd is coming back into the market. Because if they get involved, that's big money coming in, and then equities can finally pass fixed income and the FOMO drought can be declared over.
All right, excellent. Eric Balchunas, thanks very much for that. Joining our conversation now is Valerie Grimba, Director of Global ETF Sales and Strategy at RBC Capital Markets, coming down from Canada with the smoke. Thank you so much. Let's talk about what Eric just laid out there. What do you see in terms of ending the FOMO drought? Are we on the precipice?
It's quite different actually in Canada because there's not quite a FOMO drought, mainly because our equity market is flat year to date. So actually the correct trade is going overweight fixed income, is going into the fixed income trade on a relative basis. But we are kind of seeing similar trends in that it's about 2-to-1 ratio on flows into fixed income to equities, which is a very big change and something we haven't seen probably ever.
Well, if we think also about some of the big trends in the U.S., obviously cash has been on fire, in very high demand. You see that in cash like ETFs. You also especially see that in money market funds. Is cash as hot in Canada?
Even more so. Cash is definitely king, and I don't even know what the next level up from godlike maybe. These are rough numbers, but 10 billion of inflows into fixed income ETFs in Canada, about half of that is cash ETFs or cash equivalent ETFs. We have this product in Canada that we call the HISA ETF, which stands for High Interest Savings Account, and it's exactly how it sounds. These ETFs take in cash, and they put that cash into a deposit account that is paying a lot higher yield than you and I would receive in our own bank accounts.
So it's like a CD, basically.
Effectively, except for
the rates.
Yeah, they're north of 5% right now. Some of them are even yielding 5.5%. So on cash, it's really easy to see why they've been so popular and really been just gaining flows after flows after flows.
Yeah, I was there. That's how I met you. It was all the talk. HISA ETFs, if I pronounced that correctly.
HISA.
Sorry.
High interest rates.
I'll get it. Elsewhere, another thing that's taken money off of the U.S. equity area is international equity ETFs. International makes up something like, 14% of the flows, but they're taking like 45% of the flows, rather 14% of the assets.
Yes.
So they're punching way above their weight this year. I think you've been seeing that in Canada as well. What's your take on that? I never International, I just feel like it's always going to like be a short-lived rally. I don't know. What do you think?
Yes, I mean, again, it's really hard to say. It's really reading the tea leaves, but what investors are saying and where they're putting their dollars is a massive shift into international. Again, rough numbers, but there's been about $4 billion of inflows into equity ETFs. 3 of those are into international funds, which is crazy. And again, to your point, the ratios are way out of whack. And it's across the board, so it's hard to discern a theme. It's emerging markets, developed markets, country specific. It's just anything that's not North America, Canadians are buying.
What about if you look at, for example, covered calls, right?
Yes.
You have a lot of activity there. So people are planning for maybe a rotation in the future.
Yes, so I think the heart of that question is that Canadians, we love yield. Along with our ice hockey, it's yield at the top of the thing. So they look through their kind of ETF product list and they're chasing yield. And covered call strategies have been kind of the big beneficiary of that. We've seen also a bit of chasing from a product issuance type way. And also, you know, they've just been gaining big inflows because people are trying to chase that yield. But it probably will shift because those ETFs outperform in a sideways to downtrending market. And, you know, it's hard to say where it's going to go from here.
Well, we were talking about that a little bit before the show, is that when you think about some of these very yieldy ETFs, especially the covered call ETFs, they're actually underperforming the S&P 500 year to date. I'm not so sure about Canadian equities, but talk to us a little bit about the outlook, because even still, I mean, you are seeing the money continue to pour in, even though that underperformance has established itself.
Yeah, I think we're right on that precipice tipping point to when people are going to kind of wake up to that underperformance. Right now, they're happy for that yield and happy for that bit of protection. But now that markets are ripping higher, it's really going to get attention, and I think we're going to see potentially a rotation out of this covered call monster trade.
I agree, the rotation out. That said, active is here to stay in the U.S. This past year, 18 months, it finally caught on.
Yeah.
Now in Canada, active's been caught on for like a decade. Like you guys have been into active the whole time. Why is that? Because my theory here in the U.S. is they finally got cheap. We love cheap stuff here. Active got cheap, people buy it. It's not the same over there. Is that more because of the advisors think their role is to pick active and therefore you get more flows?
I think it's both. I think it's just kind of because the long history, there's a lot of comfort there. It mainly stems from a regulatory issue, is that ETFs and mutual funds in Canada fall under the same umbrella of guidelines and transparency rules. And so advisors were on board, asset managers were on board, and people like ourselves, market makers and market participants, have always been comfortable with it. So they've been around for 10 years. 10 years plus, really. And, you know, they're here to stay, and it's a crowded market in Canada as well. There's over 1,300 ETFs. So we're seeing continued rollout of active strategies, and I think there's a sentiment of if you can't beat them, join them, and it's really kind of caught on.
But a lot of times you beat us, right? Didn't Canada actually have the first ETF even before
SPY? They like to claim that. The idea was from the U.S.
And you have Bitcoin ETFs, and you had weed before we did. So, by the way, how is it going with Bitcoin ETFs and the weed business? That was so hot for a while.
Yes, yes, and we are proud to kind of be at the forefront of these trades. You know, cannabis is actually just kind of going with what's happening here in the U.S. So if there's any kind of scuttle about legalization, they rip and then they fall right back down.
Banking, obviously.
And then on the crypto side, actually what we found is the flows have been quite sticky. You know, we had this rush, 2020, end of 2020, 2021, and they've stuck around. So I think it's just showing you they're putting this as their small allocation into crypto, and they're going to stick around.
All right. Great having you, here in the United States of America. Thanks so much for joining us. Valerie Grimba there of RBC Capital Markets. Coming up after JPMorgan's ETF success, Goldman Sachs is ready to play catch up with some familiar fund names. We'll discuss that next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Cathie Wood, and we start with Coinbase. Of course, the news this week has been Coinbase's suit from the SEC. Well, Cathie Wood, she bought Coinbase across her funds yesterday, a day when Coinbase fell by 20%. We're talking about ARK K, that is her biggest fund that bought the most Coinbase shares. These are just some of her top holdings, so we're going to continue to track that. But let's talk about junk bonds as well, because HYG, it's the biggest junk bond ETF out there. If you look at the flows last week, it saw its biggest weekly inflow since 2020. Some of that money has come out this week, but we saw over $2 billion come in last week, so has not come close to erasing that. We'll keep an eye on that as well. But let's turn to what I think is the most interesting story in ETFs over the past week. Got some interesting filings from Goldman for the U.S. Equity Premium Income ETF and the U.S. Tech Equity Premium Income ETF. They sound very familiar to some JPMorgan products, which we have on the left-hand side there. One of those, of course, is JEPI, which, Matt, we talk about all the time. And
every single show.
Every single show. Apparently, Goldman's been talking about it, too.
Yeah, this is really interesting, and I guess, you know, Valerie was just saying if you can't beat them, join them. Let's bring in Eric Balchunas right now to talk about this. So it looks like just a little bit of copycat action, which is, you know, don't be embarrassed. If somebody else had a great idea and it's successful and there's still room in that market, go for it, right?
Yeah, yes. The reason this caught my eye, it was just so late. JEPI launched 3 years ago. The Flowathon started 2 years ago, and Goldman comes in this late. This kind of dovetails with their lack of growth. They came out strong. GSLC is a multi-factor product that really crushed it. It has 11 billion still, but it was up to 15 billion, and it was a 9 basis point product. You get Goldman's brains for 9 basis points, and you can see Goldman, that line just went down, and then JPMorgan's the white line. 5 years ago, something changed inside Goldman, and they, you know, I use the phrase, they lost their edge. I don't know if it was a new manager who just doesn't like the ETF business, but you could tell, especially compared to JP Morgan, they took their foot off the gas. And this filing coming in pretty late, and as we spoke about earlier in the show, this trade is a little over. So this is like a day late, dollar short filing, in my opinion.
Well, that's what I want to talk about, because, I mean, if you think about JEPI, you made the point that if you look year to date, it's only up 3%. It's underperforming the S&P 500 by a healthy margin there. I mean, when you say that Goldman is late, they're late on multiple levels here.
Yeah, and JEPI taking in flows, there's two interesting components to that. One, it's cheap. It's 35 basis points, and Goldman got cheap with their multi-factor. So Goldman, Wall Street banks are good because they can subsidize being cheap. That's why Goldman, I think, has a real opportunity to turn this around. Also, you're right, JEPI taking in money despite being down and lagging, I think shows JP Morgan's distribution power. Goldman has the same as well. It also shows a little bit of the FOMO drought. I feel like if you go into JEPI, you're basically not buying this rally. You're like, I still like JEPI because I don't think this surge is going to last, and I'd rather have my JEPI exposure than, say, chase ARK again or something like that. So there's a lot going on in the flows going into JEPI despite the underperformance, but the distribution is huge. And Goldman has that distribution. I don't know why they don't utilize it. My guess is they see ETFs as a short-term revenue killer. And when you choose revenue over growth, you tend to back off the ETF business.
I mean, in the ETF business, how much do returns matter? If you have the flows, right? If you have clients pouring money in, how much do you care if the price actually rises?
Right. So in an ARK's case or a theme, they need the price to rise. But if you have distribution and you're low cost, you got to get low cost, though. JP Morgan can't sell JEPI to its own advisors unless the advisors can be like, well, I'm being fiduciary. Otherwise, it looks like a conflict of interest. So as long as you're low cost and you got a good value proposition, you're going to get money, rain or shine, because people are going to be interested in the value of it. Its price performance is more important for something that's like a shiny object. But Goldman and JP Morgan, JEPI, GSLC, these are not shiny objects. These are buy and hold active strategies that you put in your portfolio. And you can see a chart there. Goldman hasn't really launched anything lately. Again, you look at the flows, the assets, and this late filing, and you just sort of wonder.
Are they asleep at the wheel?
I don't know. I think they're under new management. That's my guess.
I think we have to get Goldman on the show. That's
we should.
My
we'll invite them.
takeaway. Eric, this was sublime. Thank you so much. We'll see you next block. And still ahead, we're going to drill down into DoubleLine's mortgage ETF with Ken Shinoda, who manages the fund, next. This is ETF IQ on Bloomberg.
This is Bloomberg IQ, ETF IQ, Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas is back with us from Bloomberg Intelligence for today's drill down, where we focus on one ETF. Eric, what do you got?
Today, Katie, we're going to look at DMBS. This is a relatively new ETF from DoubleLine. It's a mortgage ETF, and you know DoubleLine is famous for active management in the fixed income area. And so look, it's actively managed, no surprise there. The fee is 49 basis points, which I'd say maybe slightly above average for that space, but cheaper than most mutual funds. You look at the market cap, 50 million. It's pretty good for a couple months in the market. I'm not surprised. DoubleLine has a pretty big following. In fact, kind of surprised they haven't launched a mortgage ETF up to this point because they're so known for that area. Let's look at the holdings here. Nothing, really to note here. This is a lot of mortgage bonds. Again, it's trying to identify value out there in that market, and it will deviate from the benchmark. Speaking of that, if we look at what I consider cheap beta to the mortgage-backed area, it's going to be MBB, which is the iShares MBS ETF, which charges 4 basis points. So as an active manager these days, you kind of have to beat that cheap beta version that is liquid and a lot of people will use, and so far it is. It's up 24 basis points over MBB, which is a good start. If that number keeps going up, Matt, Katie, I could see this new ETF gaining an audience outside of the DoubleLine fans.
Eric, thank you. And joining us to talk about this ETF is Ken Shinoda, who manages this fund. Ken, it's great to have you. Obviously, the mortgage market is at a pretty interesting moment right now, so it's great to talk to active managers such as yourself. When you're thinking about your portfolio here, where are you seeing the opportunity right now?
Yeah, I mean, broadly, mortgages are the most interesting and the cheapest they've been in over a decade. The spread on what we call current coupon MBS, which are bonds that are packaged by the loans that are being made today, which have around 7% coupons, are trading at like 100th percentile over the last 10 years. So just broadly, MBS is attractive, but you really have to pick and choose your battles. What you've seen is this interesting market where what was produced over the last kind of couple of years were these low coupon mortgages that everyone's in, these 3.5 coupon mortgages. Those get packaged up into 2.5% coupon bonds, and most of the index is in those low coupon mortgages. Guess who else owns those same MBS? The Fed. The Fed was buying them up during QE. Guess who else owns them? The banks. This is what was filling up Silicon Valley Bank's balance sheet and many other banks across the US. So those assets are actually trading very expensive relative to other parts of the market. And when you index, you end up getting ownership predominantly of those low coupon bonds. So to really extract relative value in the MBS market, you kind of have to go out of index. You can look to higher coupon mortgages that I just talked about. You can go into what's called the collateralized mortgage obligation market, where Wall Street packages up mortgages and slices and dices them up into pieces. We think those are going to cheapen up when we see more supply from the FDIC. And then lastly, we go into the non-agency market. These are bonds that you take the credit risk of borrowers, and you get to pick up yield over those agency mortgage bonds that are in those index funds that you buy. So there's different ways to extract value, and today we think it's really important to do so.
Ken, for those products, I wonder how worried you are about the risk. We saw people paying as much as they could for cars over the last couple of years, and the default rate is amazing right now. It's concerning. Right now, I think the same is true for home buyers, right? Especially in the non-agency market where you take that risk. Are you worried about defaults?
So first off, the 85% of the portfolio today is in agencies, no default risk, right? The government, Fannie, Freddie, Ginnie Mae, those government-sponsored entities buy out those loans at par if they default. And on the credit side, what we've seen in the U.S. over the last decade post-global financial crisis is that the underwriting quality of new mortgages being made, new non-government guaranteed mortgages, has remained really high. High credit scores, people have to put money down. You also have a ton of home equity built up for people that are in homes that they bought over the last couple of years. You've seen people pay down mortgages. You've seen the borrowers see home price appreciation. So the probability of default today is really low. Of course, that could go up with a recession as unemployment goes higher. But we've seen pandemic programs like mortgage forbearance work to help borrowers stay in their homes, miss a couple payments, and then get them back up on their feet and start paying again. So I think defaults are going to be low going into the recession that everyone's waiting for.
And just real quick about portfolio application, the aggregate bond ETFs have about 26% in mortgage bonds. Some people might say, like, well, I check that box. Would you recommend unbundling that and putting this and other DoubleLine funds, or adding on to it with a fund like this?
Yeah, look, I think that our ETF is an interesting solution for somebody that wants to get that MBS exposure. It's part of the index. So you want to have that exposure, but you want to try to buy what's cheap. You want to try to get some extra yield. You want to try to find parts of the market that'll outperform. So I think if you want active management, this is the way to go if you want to play MBS.
Ken, really appreciate your time. Great to catch up with you. That is Ken Shinoda of DoubleLine.
We should get him back.
We should get him back.
And for longer. We need more time with him.
And in person. We'll talk about how we do that. But before we go on this show, here's a special look at another ETF as we get ready for summer. Summer is unofficially here, which means that many people are packing their suitcases and headed on vacation. The ETF MG Travel Tech ETF goes by the ticker AWAY and is built to track tech companies tied to the global travel and tourism industry. As you might expect, within this ETF, you'll find among its 40 holdings names like Uber, Booking, Expedia, and Airbnb. The fund has around $120 million in assets, and timing was not on its side when it launched in February 2020, right when the pandemic was taking hold of the world and shutting down the travel industry. Its performance has suffered as a result, posting negative returns and badly trailing the S&P 500 over that time. AWAY also has a relatively high expense ratio of about 75 basis points. As travel rebounds on the other side of the pandemic, though, AWAY hopes to take off in the years ahead. AWAY gets a green light in the Bloomberg Intelligence traffic light system with one warning for its alternative weighting.
Okay, yeah. All right, and by the way, we just got a headline. If you're in the New York metropolitan area, you've seen a huge cloud of smoke hanging over pretty much
It's hard to miss.
Yeah, it's massive. So the FAA has now established a ground stop at LaGuardia until 2 p.m. due to low visibility. That could stop travel for a little bit, but it's been going crazy lately, right? And especially this ETF that we're talking about is interesting because at one point it wasn't going crazy.
Yeah, me and my team looked at this. This is the worst time launch I've ever seen. It launched 2 weeks before COVID shut everything down, and we were like, oh, this is going to go away. But it hung around, which is important in the ETF space. You hang around, you wait for the cycles to change, and now, it's getting its day again.
Away.
Away. There you go.
Maybe
Travel
not today,
stocks. We're crushing it for a little bit, but maybe not today.
All right, that does it for Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld and Eric Balchunas. This is Bloomberg.